Hey YouTube, this is Zach with Achilles Financial, and today I'm going to be talking about an oil ETF that we've been looking at the channel at a number of times, and that is Gush. If you recall, I've been talking about this for about 2 months now, and inclusive of what we talked about last year. The important thing I want to highlight is right at 2 months ago, we were talking about, hey, we want to get into Gush and we want to play it long. I think that this is a great ETF that you can use for swing trading, as well as one that we can utilize for playing oil in the long game. And I'm still very much so long oil, although I think we may expect to see a pullback in Gush in the near term future, although I will be watching it very closely. This is a leveraged ETF, which means that the more oil goes up in a single day, the ETF will be going up in accordance with that, and the more they go down, the ETF will be going down at an extended rate. So it's very volatile, and I would definitely make sure that you're aware of the risk associated with investing in leveraged ETFs. The reason why I'm highlighting Gush in particular today is because we saw a big increase in oil, including Brent crude, which is one of the key metrics or the key services or oil producing items that we evaluate, hit a new high for the calendar year, north of $70 a share or $70 a barrel. And we are actively watching WTI, West Texas Intermediate crude oil, which the price is sitting just south of $68 a share. This is super important to watch because the bulk of the United States spending can be tied to the price of oil, whether that's the transportation cost associated with goods and services, or just purchasing it at the store and what it took to ship there. So this is super important and something that I want to continue to watch. So let me showcase my expectation of the bull case and why I can expect oil to continue to rise despite the fact we've seen just a monumental rise going forward. And I don't know if I'm going to strictly utilize Gush going forward because we've seen such a strong, fast run up, but we are going to be watching the oil and energy sector. So the first thing I'm going to showcase is the actual prices historically of West Texas Intermediate or WTI. As you can see, we've actually climbed pretty rapidly. During this point in time, the price of oil actually went negative last year because people were trying to just get it off of their balance sheets, out of their inventory. And you can see that we've actually returned to pre-pandemic highs, and we want to watch this going forward. The reason why this has increased so rapidly is because right now what we're watching, or as this continues to climb, what we're watching occur is that we are seeing a rapid expansion in travel and in European economies opening up to match the pace of reopening here in the United States, as well as at the same time there's been a large decrease in production. You can see a lot of that here in the United States, that the current administration is not favorable towards oil, and we can expect that that's going to continue to be the case. So that being said, with the increased decreased production, increased travel, you can expect to see that continue to close down and this price to continue to climb. A few other factors that I'm going to be watching. Here on my screen, we have the air revenue passenger miles, essentially how much are people flying. I have no belief that we are going to ever see air passenger travel get back to the same level it was pre-COVID. The large reason behind that is going to be business travel and the lack of a need for it that a lot of companies have seen. And air travel is one of those industries that the business class was the one that was bringing in a lot of money. The people who are on the road every other week or every week, not the people who are going on vacation once or twice per year. So that being said, we are seeing a rapid increase here, and I would not be unsurprised to see back up to the 60 million or 60 billion air revenue passenger miles within the next calendar year. So this is one item where we're just seeing incredible increase in demand, and I anticipate that that's going to climb as well. However, there is more. Here we have the moving 12-month total vehicle miles traveled. Again, all of this data is coming from the FRED database, which is the Federal Reserve Bank of St. Louis. You can see that we are slowly but surely increasing in the 12 months. So this is the prior 12 months. So this is all going to be inclusive of a big, large slowdown, but this is increasing at a rapid level. So we are constantly increasing that demand very, very, very rapidly. So this is what we're going to be watching going forward, is we have not only two of the key metrics by which we're looking at are increasing rapidly, but also our supply is decreasing, and this is how. So this is strictly the United States production of crude oil, and you can see that it's declined pretty rapidly from where we were doing 13,000 barrels a day previously, and now that's down to about a third of where we were at. The other thing that is occurring right here, and some of the news that hit today, is OPEC, which is the group of nations in the Middle East that decide on oil output and prices. It's a cartel. They are essentially saying that they will not be increasing at a rapid pace. The reason they're doing that is price controls. The United States doesn't appear to have any intention of increasing their production. In fact, they are scaling back pretty rapidly. So if that's the case, we have all of these catalysts for increasing prices of oil, and there are a few different ways that we can play it. The first of which is Gush. Again, this is a leveraged ETF. I do anticipate that they are going to continue to see near-term, short-term success, and this is something that I want to play in the short to medium haul. However, remember that if the stock trades sideways, you're going to start losing money and see some of the volatility associated with these ETFs are going to be trading downwards. So again, it's not a long-term hold. The one that I do like as a long-term hold is going to continue to be Exxon. The reason for that is they offer a dividend, they are buying back stock, they have strong management, and I anticipate that we're going to continue to see additional growth in the sector despite the fact that the United States seems to be going towards more of an electric approach. However, right now that volume is just not enough to make a huge difference in the short term, and I anticipate that Exxon is going to continue to be a power in the near future, even if it's simply as a dividend investment or they continue to buy back their shares. So these are some of the ways I'm looking to play the oil price expectation going forward. I made a comment at the beginning of the summer that, or really the beginning of the year, that I anticipate seeing oil above $100 a barrel. I do not believe that that's outside the realm of possibility. Potentially not by the end of the summer now, but still I am holding to the belief that we will see the price of oil, WTI, go north of $100 a share this calendar year. If I'm wrong, I'm wrong. So far, these investments still continue to be doing well, though. So let me know in the comments below if you have any questions about this material, or if you want to join the Discord. We talk about this stuff fairly often. And if you find this content helpful, please leave a like and subscribe. Thanks. Appreciate it, and talk to you later.